This morning, Swedish investigators confirmed suspicions of many, saying that the recent leaks in the Nord Stream gas pipelines from Russia to the EU were caused by detonations. Now, they don't say who was responsible for those detonations, but nonetheless, they say the preliminary investigation has, quote, strengthened the suspicions of serious sabotage. Let's talk about the natural gas dynamics in that area and indeed around the globe. For that, we're joined by Goldman Sachs head of natural gas research. That is Samantha Dart. Samantha, it's good to see you again. So we got this report this morning. Again, it sort of confirms what a lot of folks had suspected. I don't know if it changes in your mind the calculation, the risks to supply, knowing indeed that it was detonations that caused those leaks.
It doesn't really. We already expected, and I think this is pretty much consensus, that Nord Stream 1 or Nord Stream 2, for that matter, would not flow gas to Northwest Europe, not only now, but going into next year as well. So our Northwest European gas balances remain the same.
Okay, and so, I mean, for those of us who are still trying to admittedly wrap our heads around this fully, I mean, the price impact that this would have towards the end users, the end consumers of this natural gas as well.
Yeah, so what the region is having to deal with is a massive lack of supply, right? This has been already established since the flows from Russia have been curtailed and increasingly curtailed over the course of this year. As a result, we have seen prices skyrocket to 10 times or more their 10-year average, and we expect them to remain elevated going forward. Now, sequentially, it's a bit tricky because over the course of the winter, actually, if winter temperatures are close to average, we expect prices to drop a little bit and bring a little bit of relief because you have enough in storage to deal with that deficit. Now, going into next summer, yes, we still expect extremely elevated prices over 230 euros summer next year.
Samantha, your colleagues over on the oil side of the equation raised their forecast for Brent, I know. If oil prices start to trend back up higher, will we see an uptick in natural gas demand, or is that demand just kind of firmly capped by the price action we've seen on that side?
So you're right that under this surprisingly bullish OPEC cut that has been announced, the balance for oil looks even tighter. And as our colleagues highlighted, you still have the risk of potentially a $30 per barrel spike to oil prices from here. Now, even taking that into account, natural gas is still so expensive that it would continue to provide an incentive for users to substitute actually away from natural gas and into oil. So one interesting anecdote that we've been seeing, especially going into this winter, is that now this gas to oil substitution is not even just about the power generation sector, but it's also happening, starting to happen in the industrial sector, where some users, instead of buying incredibly expensive natural gas, they're opting for using oil in their boilers instead.
Samantha, if we do, in fact, go into a more prolonged recession or economic slowdown, where do you see prices for natural gas going?
So the interesting thing about this slowdown that we are seeing, especially in Europe, is that it's being caused by the lack of natural gas, right? So think about it this way. We don't have the normal supply of natural gas. So the only way to manage storage, the only way to guarantee that we're not going to face blackouts in the winter is to curtail demand. So this is why prices have been so elevated. And as a result, yes, we're seeing aluminum producers cutting back, fertilizer producers, cement, glass, refineries. So industrial activity is indeed slowing and bringing Europe into a recession because of the lack of natural gas. So this is what needs to happen until this deficit in gas is resolved.
Goldman Sachs head of natural gas research, Samantha Dart. Always good to see you. We'll talk to you soon.